Tom from Parallel Economy. Today, I just want to talk about banking system breakdown, why a lot of commentators think that our banking system is in danger of failing, and just go through the reasons for that. In the UK, we have to borrow a lot of money. We import more than we export, and in the last quarter, data issued by the ONS, that's the quarter ended 30th June this year, we had to borrow 32.5 million to meet the difference between imports and exports. Most of that came from soaring cost of energy, oil and gas. Anything else that is priced in dollars also went up a lot. And that's because the underlying commodities prices went up, but also the pound devalued quite considerably against the US dollar from the beginning. From a year ago, we're down 18% against the dollar, so that just makes everything a lot more expensive. Added to the import-export imbalance, our government runs a deficit as well, and it too has to borrow mostly from other countries. And its borrowing requirement has been going up year after year after year. And as you can see from this graph going from about 2000 to the current time, it's just going up from the bottom left to the top right. Because we have to borrow mainly from overseas, we have to compete with other countries for that money, the money that's being lent. And we have to offer competitive interest rates to secure that money. Since the beginning of the year, the 10-year Treasury gilt, which is a benchmark for interest rates, has gone up from 0.9% to 4%. So it's gone up 4 times so far this year, which is a huge increase. So we have this kind of loop, which I call a doom loop, where the public sector borrowing requirement, that's the government's requirement, the current account deficit, that's imports being more than exports, mean we need to borrow more, and we need to increase interest rates as we compete with other countries for that money. Added to that, inflation's been running very high, around about 10% here. And our Bank of England and also in the States, the Federal Reserve have been hiking interest rates, short-term interest rates as well. So interest rates have been going up. As I mentioned, the underlying commodities, especially energy, have been going up. They're all priced in dollars. So to buy those commodities, we have to get hold of dollars, and so do other countries. So there's an increased demand for US dollars, and that causes the dollar price to go up. So the exchange, that's why we saw the UK GBP exchange rate falling against the dollar as it has done. And this just goes round and round. And what can stop this loop? Well, in 2007, 2008, we had the great financial crisis, and essentially the banks failed or were on the verge of failure because they couldn't get any money to refinance their loans, and the central banks had to stand in. So this loop could be stopped by a central bank intervention, or it could be stopped by the Federal Reserve, particularly in the United States, stops increasing its interest rates and starts reducing them to take the pressure out of the system. So what could break? A lot of commentators say something in the derivatives market will break and then cause the failure of one or more banks. And because banks are very interconnected globally, if one big bank goes, it'll affect a lot of others, potentially all of them. This picture is of Exeter's pyramid. John Exeter was one of the top honchos at the Federal Reserve, I think in the early 70s, and he created this pyramid, and it shows showing all the global assets. And derivatives have a value, a nominal dollar value of as much as all other assets in the world. So they're huge. And we saw in the UK a few weeks ago a breakage in the derivatives market. where UK defined benefit pension funds um, had made derivative bets, and because interest rates had increased so much, those bets were going wrong. They had to get out of those bets, and the way they did that was to sell the assets in the pension funds, which are very long duration treasury notes, so 30-year UK government gilts. And as they sold more, the price of them or the value of them went down, and so they had to sell even more to close these positions. And the Bank of England had to step in and become a buyer to prop the price up. As interest rates go up, the cost of financing the loans increases. Your interest cost goes up. Companies' cash flows and profitability go down. Households have to pay a lot more interest on their mortgages when they renew their mortgage loans. And unfortunately, some companies and some people won't be able to afford that, and they will go into insolvency or bankruptcy. And if enough borrowers go insolvent, then the bank goes insolvent. We can see the strains on the banking system with liquidity shortages, and signs of that are in the US. The Federal Reserve has to lend very short-term or make very short-term loans and liquidity, known as liquidity, available to banks. So that's called the repo funds, overnight repo market, and the amount being lent each night is absolutely huge. It's in the billions of dollars and increasing. They also offer swap lines to other central banks around the world who need dollars. As I mentioned, they need to find these dollars to pay for the commodities and the dollar-denominated imports. So they've given swap lines to other banks, and one of the biggest borrowers on those swap lines is the Swiss National Bank, which then lends those dollars out to its domestic banks and other banks who can't source dollars in the money markets. Because if there's a liquidity shortage in the money markets, that's essentially a silent bank run going on. It's not depositors queuing up at the bank to get their money back. It's other banks just not being confident enough to lend to their fellow banks. In Switzerland, one of the biggest banks is Credit Suisse, and it's been doing quite badly over the last five or more years. And over the last 5 years, its share price has tanked by more than 75%. It's been involved in a lot of scandals, been fined a lot for what it's done, and it's just not been making very much money. And it might be one of the recipients, it probably is one of the recipients of these swap line funds coming from the Fed, because it can't get dollars from other banks as it normally would. So its national bank has to lend it that money. This is the same chart, but just showing the last 6 months, where in the last 6 months alone, it's lost nearly 32% of its share price. So this could be one of the big red flags. It's been noted by a few commentators on YouTube, I've noticed. Anyway, so it looks like there are signs that the banking system is under a lot of strain, and we could be faced with similar problems to those of 2007, 2008. And it might be that your bank has a problem, and you need to be ready and prepare for that. So if you want some advice on that, I think my other video on my channel is quite useful, so take a look at that. If you like this video, please do all the YouTube things, give me a like, subscribe to the channel. I'll be posting some more video content of a similar nature as soon as I can. So thanks very much for listening, and goodbye.